Joining us here first on CNBC for an interview is Columbia Sportswear CEO Tim Boyle. It's good to have you, Tim. What are you seeing from the consumer right now?
Well, it depends on where in the world you're talking about. So the Chinese consumer, frankly, is quite robust, and our business there has been good. You have to remember we underperformed in that market for several years, and we believe we have the right team in place there. So that business is going well. Our European business is going well. And frankly, I think the U.S. business is as much responding to warm weather than in almost anything else. We have a big portion of our products are weather related. So, it's important that the weather be appropriate for selling winter goods in October.
Is it the weakness coming in orders from wholesale specifically in the U.S.? Is that where you see it? Because direct to consumer has been good, hasn't it?
Yeah, when we talk about the most current quarter, it's really about loading the shelves for retailers. And then when we talk about the future, it's about how we perceive the weather, likely weather. We hope for a normal average weather, but retailers are becoming quite cautious. And so we have our own stores, but we also have a big business in selling to other retailers. And those retailers generally are becoming much more cautious about 24.
What about inventory management during this period? How are you dealing with that?
Well, as you know, and we've been quite open with our investors that we had a lot of inventory at the beginning of this year. Most of it was a function of residual impacts from the pandemic and logistics issues around the pandemic. But we spent the year, and we're quite proud of reducing our inventories and still maintaining our gross margins. So that's a big part of our story. We have a very strong balance sheet, so we can approach inventories in a way that we can liquidate over time. We don't have to go crazy and mark stuff down, impacting our gross margins. So now it's really just managing for the residual portion of the inventories. We've told investors that we plan to reduce our inventories as against last end of year by about another $200 million. So good stuff happening.
Tim, you mentioned that the retailers are pretty cautious at this point. Do you think they're wrong? I mean, about reading what the consumer is ultimately going to be able to do into next year?
We have such a broad swath of retailers that it's hard to know, if they're wrong or right. I just think the general focus has been, let's just take a little smaller, more conservative approach to next year, and we'll try and chase goods. And if people have them, they'll be fine.
What about across channels? Are your outlet stores outperforming the e-commerce and the other stores because of the value nature of this consumer?
In general, our brick and mortar stores, which are mostly outlet stores, are outperforming the other components, which are for us e-commerce. Although we have great business in pure play retailers across the world, really. So it's a mixed bag.